All right, so next up we'll talk about Social Security. Um, so for the next few presentations, I'm going to use the materials from the open courseware course that the text comes from, mostly because there's a lot of law specific detail required. And as you can see, this is updated in March of this year. These things do change relatively frequently, right? Tax law gets passed and amounts get updated and then it has to flow through all the tables. So, and you'll see there's a lot of detail in our discussion of Social Security that will come up. But I guess the reason we're talking about Social Security first is that Social Security has a profound effect on wealth management generally, because a huge portion of wealth management planning surrounds retirement, and a huge chunk of the median individual's retirement savings comes from Social Security. And the existence of Social Security feeds back into the retirement planning decision in the first place, right? So if you're ignoring Social Security when you're figuring out how much to save and retire for your retirement, you will, in effect, oversave in the following sense, right? Any money that you set aside for retirement now is not being spent currently. And no matter what we're doing, right, we have to decide whether, right, all of the money that we earn is ultimately spent on something. It could be spent on a donation. It could be spent on a bequest to our children or our beneficiaries. But it will have some use, right? There will be something that gets done with that money. And if we had an opportunity to do something now that we didn't do because we contributed to a retirement account, not factoring in Social Security, we might make suboptimal decisions, right? So maybe it would have been really nice to do a modest family vacation, but you were in such a panic about having enough money to even survive with enough calories in retirement, you'd put it off and do it, not factoring in the fact that Social Security might exist when you retire. And so, and we do see, right, declining household savings rates in the United States, but that's not necessarily true once you factor in the presence of Social Security, right? So you would assume that people would rationally plan on the Social Security benefits that they can anticipate, and then supplement those benefits with additional retirement savings, right? But the options aren't either I live out of my own retirement accounts exclusively or I live out of Social Security exclusively. Of course, most people will fit in a group of both, where I have private savings and I have Social Security savings, in quotes, and together that constitute my retirement planning. Which means, again, Social Security is a huge chunk of the income in retirement for most people. So we're, in this lecture, trying to get an understanding for how the system works, what the benefits look like, and what are some key questions in terms of qualification and receiving benefits, and what it will likely look in the future. Now, there's a general principle that applies to Social Security and other retirement investments, and that you have to plan for the contribution accumulation phase, the money going in, and plan for the receiving phase, right? Social Security doesn't give you a lot of flexibility there, but there is some, right? But in particular, Social Security will generally pay you an annuity style payment, right, where there's payments that occur every period with some cost of living adjustments, and that's the typical way to receive a Social Security benefit. And that's not necessarily true for other savings goals, right? So if we have a personal goal to go on a river boat cruise in Europe, well, that's definitely not going to come out in periodic payments. It will come out in one big check when we pull the money out to go do the vacation. Same with other big ticket purchases. College savings don't come out in one big chunk, but they come out in 4 to 6 smaller chunks, right? So the there's a strategy to how we accumulate the funds that we need for whatever our savings purposes, and then there's a strategy to withdrawal of the funds. And those strategies get quite complicated once we get into the tax-advantaged vehicles. But for Social Security, it's somewhat complicated. So we'll get into all that in this lecture. So the first step to understanding Social Security is to get your Social Security statement. Now, I was enrolled in payment statements, so I got them in the mail frequently, but as part of preparation for this class, I signed up for my account on ssa.gov and enrolled in online online account information, the one where they're going to email me now. But this process is fairly simple. You go through and give them some information, Social Security number, an address, answer some questions. You get into your account and it will give you your benefits history. So how much have you contributed each year to Social Security wages, and what your anticipated benefit will be. It was fun actually for me going back and seeing how much, what were my Social Security wages in the year I was married with a small child, but still an undergraduate. That was not a big number. But I think your work study maybe gets treated a little differently. I don't think, there's no, there's not necessarily Social Security taxes paid on work study money, which means it doesn't count as credit towards Social Security. Anyway, so there's a little walk down memory lane in terms of my own employment history. But you create the account. It's pretty straightforward. You just do it, and you'll get a big list of all of your Social Security wages for each year that they have in the system, and then an anticipated benefit. Now we'll get into those anticipated benefits later. The benefit prediction that they give you on the page is basically extrapolating your current annual wage out into the foreseeable future. If you were to retire immediately, let's imagine that you're 65 or 66, and you retire immediately, that wage might not be the same because you won't continue to contribute, right? Or if you decide to retire early and just live as a freegan for the next 20 years, your benefit amount will be significantly smaller because the one that they're telling you assumes that you continued working. Okay, so let's get into the particulars about how Social Security works. So Social Security was created in response to a dramatic decline in the American economy during the Great Depression. So, this is a pretty shocking number. GDP fell 48% in nominal terms. So that's huge, right? If you figure, if everybody quit, if all your 40-hour-a-week jobs turn into 20-hour-a-week jobs, you'd get that kind of GDP decline. Now, it's a little bit overstated because we went through a significant period of deflation, and there's kind of some interesting history there because, right, if prices are falling, that means interest rates are by definition whatever they currently are, plus all the price decline value, right? So if prices are falling 10%, if I lend somebody money, then I will earn whatever interest I earn plus the additional 10% I earn because stuff is now cheaper. And so it became very, very expensive to borrow in the Depression because even if you got a tiny interest rate, even if it was like a 3% or a 2% rate, your effective rate was 12%, 13%, because prices were falling so fast. And that meant that investment was not smart. It didn't make sense to make investments because you had to have these huge percentage returns on your investments to invest it all. And investment is what drastically declined in the Great Depression, not necessarily government spending or consumer spending, at least initially. So we had this great decline in investment, which sort of sent this shudder through the job market, and that softened up consumer spending, which fed into declining investment, which sort of sent this big downward spiral, and we have this huge decline in employment. The unemployment rate was in the 3% range in early 1929, and pretty soon we were looking at 25% unemployment rate. So often if you had savings, you lost it when banks were failing. And so there was basically a lot of people, through no fault of their own, who didn't have any way to live through retirement, even if they had been saving for retirement carefully over their lifetime. And so the government stepped in and created the Social Security program, and the idea was that current workers would pay a percentage, like a payroll tax, just a percentage of their earnings, and then that money would be turn around and pay towards retirees who were currently in trouble because of all of these things happening. So it was never really a saving system. It was a pass-through account from current workers to future retirees. But at the time, there were 17 workers per retiree, and so the payroll tax amounted to 1% of wages. So we can imagine the appeal of this policy at the time. If you pay a 1% tax on all workers, and suddenly everybody who's retired under the sun can have a livable wage in retirement. So this is very attractive. Unfortunately, demographics have worked against it, and now we only have 2.8 workers per retiree, and things are a little bit financially shakier, right? We have to pay a higher percentage of our wages towards Social Security taxes, and even given that higher tax rate, we still have concerns about the long-term viability of the financial structure of Social Security as it's currently constituted. So how does it work right now? So we lump all the payroll taxes together into this category we call FICA, and this is the old age survivors and disability insurance coupled with hospital insurance, right? The old age survivors and disability insurance pays into the Social Security system, including Social Security disability and Social Security retirement, and then hospital insurance is what contributes to Medicare. So we have a total paid by employee of 7.65%, but this is met on the employer side, and by the same amounts you get a total of 15.3. And again, you end up with a pretty significant, pretty sizable chunk of tax in your pretty sizable chunk of tax relative to maybe income taxes. And that was part of my, you get your little form. It tells you what's your total Social Security taxes over your lifetime, and I guess it depends what you think about what's a big number and what's a small number. In terms of retirement savings, it doesn't look like a big number, but if I think about, it'd be nice to have that check right now, it seems like a big number. Now that this percentage is different if you make over $250,000. So there's an additional Medicare tax above a certain number. And there's another interesting feature: the Social Security taxes phase out past a certain income number, and but the Medicare tax doesn't. So there's for high income individuals, there's some additional sort of complexity there. And there's also some weirdness, right? Because it's possible that you can have a very large, so your monthly wage might look like you have a huge annual wage, but maybe you don't have that wage all year. So then, you still might be paying the 6.2% on an income of much larger than $250,000 annualized, but still have significantly less than the max payout on an annual basis. This would be very seasonal work. I'm not sure exactly what would be a natural fit for that, but it's possible. So what are Social Security taxes based on? They're based on taxable wages. So again, the key here is that these Social Security taxes are, right, this is not like your taxable income, right? So if you're going to use the standard deduction on your federal income tax return, that deduction does not apply to these taxes, right? So there's no, right, we think about all of these things. There's very few things that that would be excluded, right? So employer provided meals and lodging have different rules for income tax versus FICA tax and sick pay and all this stuff. Okay, so point is there are very, very few things that count as a deduction against Social Security wages, even though there are lots of deductions against some, like something like AGI or taxable wages. Or not even AGI, because there you get deductions against AGI. So so we got this big list here. So this is really important right here. Employer contributions to qualified retirement plans are not included in Social Security taxable wages. So this is right. So in the universe of things, there are very few things that, right, there's very few ways to get paid that don't create a corresponding Social Security tax liability. But one of them is to get an employer contribution to a qualified retirement plan, right? And that's part of where a lot of the ammo comes from doing these, somewhat complicated retirement plans, is that they create a reduction in Social Security tax. They create a reduction in FICA tax. And those, in many cases, that's much larger than your income taxes, especially if you're a single wage earner, if you have lots of kids, right? I'm both, right? I've got 5 children, and I'm the sole wage earner, and for the most part, and so the Social Security tax relative to my income tax is pretty big. So there's a couple key terms. We have average indexed monthly earnings. So this is key calculation here. So when you're thinking about Social Security, your ultimate benefit will be your 35 highest earning years up to age 60. So if you have a really good period and then you go back down, the really good period will count because it will be in your 35 earning years. And my tiny pittance I made being a dishwasher for the food court at my university probably won't end up counting for the calculation of my benefit, because it will likely be I have 35 working years that are bigger than that. But again, that's not necessarily for sure. It depends on the nature of your career. If you spend time as a stay-at-home dad, then maybe you won't have as many years. Or anyway, so there's lots of things that can go into that, but it's the 35 highest years. And so that means, for example, if you have an opportunity to maybe do a small business after retirement, maybe you retire early and you have an opportunity to do a small business in your late 50s, it's possible that can increase your Social Security benefit even if the numbers are not small, if you don't have 35 years in the system, because then that will replace zeros with the small number. But if you have 35 normal years in the system, doing years 36 to 40 and a little side job is not going to benefit you because it won't count as a high earning year. So that's so there's some strategy in thinking about career trajectory affecting your ultimate Social Security benefit. So the primary insurance amount is a basic unit, right? Okay, basic unit used to express the amount of a worker's benefit if they received benefits at their full retirement age, right? So, which depends on when you were born, but so 65, 66, 67, depending on when you're born, and you have this calculation that says, okay, if you retire at your full retirement age, what is the benefit that you can expect to get, but you have some flexibility when we retire, so that can get adjusted, but you sort of have this baseline. So calculating the primary insurance amount from the average index monthly earnings, right, is divided into 3 categories. They're called bend points. Basically what it means is the first little bit of money you contribute to your Social Security generates a lot of benefit, right? So the early dollars contribute a lot towards the Social Security. The dollars in the middle contribute some, and then the dollars above that contribute a little, right? So this is 90, 32, 15, and these are monthly amounts, right? So if you have monthly wages above 5,000, then those additional wages will be contributing to your benefit, but not a ton. And right, so this is the up-to-date chart on this stuff. So here we go. Let's see, and these are based on the dollars, right? The primary insurance. Oh gosh, primary insurance amount. So these are the bend points, which means that for individuals there's 3 phases, right? So the dollars under $791 a month get treated with the 90%, and then dollars between $791 and $47.68 are that second amount. And then there's 3 bend points, so 4 regions for max family. So this would be, right, if you have a working spouse, then they would have their own individual Social Security with its 3 bend points, but then together you have a joint family thing that's all figured out. But again, the general principle is that the more you earn past these, right, the more you earn, the more your Social Security benefit will ultimately be, but that is less effective the higher up the income stream you go. Right, so it works kind of like the opposite of income taxes, right? The more you earn, the more tax you pay. The more you earn, the less Social Security benefits you earn. But you still earn some, right? You're still earning benefits. It's just at the lowest percentage at the high income levels. And so we have this. All right, full retirement age is the year at which you get 100% of your entitled benefits. But so 100% of it's basically a baseline, right? Because if you retire early, you get a reduction in benefits. If you wait and retire later, you get an increase in benefits. So FRA is basically, this is maybe the standard age for your birth cohort, right? Notice if you're born after 1960, your full retirement age is 67. So if you retire at 65, that would be retiring 2 years early, which would produce a reduction in benefits, which we'll get to. And if you retire late, then you get an increase in Social Security benefits. Again, because it's demographics working against you, right? If you delay accepting payments, you're likely to, so you'll die at some point, and you'll be dying relatively 2 years sooner in terms of the number of months you're collecting. And so that means the government can afford to pay you a bigger benefit on average, right? So the group that retires 2 years after their full retirement age can afford to pay higher payments than the group that retires earlier. So how have the Social Security tax rates changed? Well, like I said, it started at 1%. And now we're at 6.2, so it's been gradually increasing. And this makes sense, right, as the number of workers per retiree has declined, as healthcare has improved, and life expectancies have increased. We have a decreasing number of workers per retiree, and that means we need to pay more into the system for the numbers to work out. But you also notice maybe that this is, so this is maybe 20 years-ish, 6, 10, 6, right? That these taxes have been increasing every 6 to 10 years. And then, right, we go roughly 30, almost 30, right, 25, without a significant increase. So the lack of increase in the Social Security tax is maybe unusual given the modern history of the United States. But at the same time, I think, right, a 1% tax was easy to sort of roll with, but now, these are starting to get bigger. And notice this movement was pretty small, right? This is 1, 1, 1.7, 1.1, 0.4, right? So that we're losing, you can feel the system losing steam on pushing through Social Security tax increases. So a worker is only entitled to receive benefits if that worker is fully insured. So to be fully insured with the Social Security system, you have to have worked 40 quarters of work and earned at least a certain amount. And so this matters because if you are a sole wage earner of a married couple, right, you are insured, but your spouse is not. But they are entitled to, they're entitled to spousal support if, so in the event of your death, your spouse, your non-working spouse, will receive some of, there's rules about this, right? But they'll receive some of your benefit, right? Which is different than if both spouses are working and both spouses are fully insured, right? Then they have their own Social Security with their own Social Security benefit, which, in the case of a non-working spouse, this wouldn't happen. So you see, I see this a lot when preparing tax returns for farmers. You'll have a farmer and then you'll have a spouse, and it's very common for the farmer to have self-employment earnings from working on the farm, but then the farm itself will hire the spouse to be an employee of the farm and pay Social Security. So then the employed spouse is paying into the Social Security system, whereas the farmer may or may not, depending on whether the farm is profitable in a given year, and often on paper they're not. Right? Farms tend to accumulate a lot of wealth in land, so in any given year the operating profits from a farm might be very low, and so there's sort of maybe some question as to how often, right? So it might be hard for a farmer working diligently for 40 years of their life to get 40 quarters of work into the Social Security system. It may not happen. And so paying a spousal employee is a way to make sure that there's something getting in the system. There's also status currently insured. Currently insured workers have worked a minimum of 6 quarters in the previous 13 quarters. So you would think, well, if I have my 40 quarters in, why does it matter if I'm currently insured? Well, there's a difference between, so currently insured people are able to get some additional benefits that if you are fully insured but not currently insured, there are some things that you're not able to get. And we'll get into that in a second. So Social Security benefits are divided into 4 areas: retirement, disability, survivors, and Medicare. Right. So retirement is sort of the flagship we think about, where you pay your Social Security taxes into the system, and then upon retirement you get checks. Right. So that's sort of the standard. So disability is in the event rather of retirement, you become physically disabled from doing work, qualify for disability. Then those disability payments are paid out of the Social Security system. So in the in the most recent fiscal year, I think there's $60 billion or 60. Oh, how's that? I have to be careful. I think there's, because it's 60 million retirees. So, here, what we'll do, we can hop on over to, this is the Social Security facts page, and to just give you a feel for the distinction between the two. So we have 60 million, that's actually really 61 million people who currently receive Social Security benefits. 44 million of those are retired workers. 6 million are survivors of deceased workers, and 10.5 million are disabled workers. So we have, basically, right, about, so I guess 1/6 of the total are disabled, and almost 5, and the remaining 5/6 are split between retired workers and their survivors. But and then we can go in and look at the actual dollars paid out, right? And so there's $900 billion paid out of the Social Security system. 768 of it went to retired individuals, and then 143 billion went to disabled individuals. So Social Security disability is it's not anywhere near the majority of the Social Security benefit, but it's a significant dollar amount in terms of the what Social Security actually does for society. So retirement is the biggest by far, but then disability is large. Survivors we saw was about half of disability. And then and Medicare is different in that it doesn't involve direct payments to individuals, right? It's payments to hospitals for medical care, but there's still expenditures happening there too. So let's see. So looking at retirement specifically, benefits are, again, this is where we're getting into the specifics of adjusting your retirement date. So if you retiring early will reduce the benefit paid. So full retirement age, depends right on when it is, 65, 66, 67. But so if you are full retirement age 65, if you begin your benefits 3 years early, that is reduced by a maximum of 20%. So whatever your benefit would be, it's reduced by 20% to start collecting at 62. But as the full retirement age increases, once you get to 67, it's possible, if you start at 62, to reduce 5 years early, and that's subject to a maximum reduction of 25%. So taking the Social Security number to benefit 5 years early produces a maximum reduction of 25%. So taking it early or late depends a lot on your expected life beyond retirement age, and that depends actually on your health status near retirement. So if you can anticipate living into your late 90s, then retiring early makes less financial sense than if you are suffering some serious health problems or expect not being able to benefit much from your Social Security benefits past a younger age. So that's a strategic question for each individual. So that's the early. So delaying gets a credit. So if you're at 67 full retirement age, you could delay up to 3 years, and that would be worth 8 percentage points per year in additional benefit, which again, right, would depend on your health status at the end of life. Also, right, I have a good friend who faithfully and diligently works at Shopko way past traditional retirement ages, and so that can affect your tax status, right? So if you were a retail clerk at Shopko at age 70, well, if you start collecting your Social Security, now you have Social Security wages plus your work wages that will push you into a higher tax bracket because you'll have a high income year that year. It might make sense to delay receiving Social Security benefits so that way all of your income is coming maybe more spread out at a lower tax rate. So family benefits. So these are benefits to family members of, right, if you have 40 quarters in the system, then you're fully insured and your family is entitled to some benefits. So if you're a fully insured worker, your eligible spouse is eligible to 50% of the worker's primary insurance amount, right? So whatever you're entitled to as the worker, your spouse is entitled to 50% of that, but there's a family maximum, right? So if they have their own Social Security, your 50% might add up to over the maximum and get reduced. But if in the case of a non-working spouse, that generally wouldn't be the case. So the reduction of benefit from early retirement will not affect the amount of the spouse's benefit. So again, if you retire at 62 instead of 65, it reduces your amount, but would not reduce your spouse's benefit. So if you divorce, it's as long as the marriage lasted for at least 10 years. and if you're taking care of kids, or right, so there's some special exceptions, but I mean, to write lots of little rules around that too. So that's spouse benefit. There are workers' benefits. So workers' benefits are different from retirement benefits. This is where this where disability comes in, right? So if you are disabled, you get 100% of your PIA until your disability ends, or you die, or get to full retirement age, in which case your disability benefits convert to retirement benefits. And so the spouse benefit for disability is half, just like on retirement, also with subject to the family maximums. For kids, there's so any children under 18 still at home, right? So if you're a child, you're eligible to 50% as well if you're the beneficiary of it. So especially this is relevant for disabled workers, right? That they're more likely to have children at home, and so the children children could benefit from despite the working parent's disability. So you have to be again. So you have to be fully insured to get the other survival's benefits, but also the disability payments are for currently insured workers as well. And you can imagine why this is the case, right? If I have 6 workers, 6 quarters of the last 13, I'm, I guess a working member of society. And so if I'm disabled and can't continue working even though I was a worker, then that would qualify me for disability. Whereas, right, if I am a person who has 40 quarters in the system, but is not currently insured, right, that can be different. So there's a lump sum benefit. Let's see. Let's get to some of the more specific stuff. All right. So this is for deceased spouses. Right. So a widower benefit is different than a spouse benefit because so now you're actually deceased, and so the dollars heading to the household end up being the same, right? Well, actually, I guess it would be reduced because you're missing out on your spousal benefit, but you get 100% of the deceased benefits. And again, so this sort of comes up sometimes that the surviving spouse is eligible if they're not remarried. So this is sometimes an obstacle to getting remarried, or like it becomes relevant if you're thinking about remarrying in old age. That is going to affect Social Security benefits a little bit. So tied up in all this is the notion of the maximum family benefit has been mentioned, and that's important in this context, right? Because we go back and look at all these other benefits, or if I'm disabled and I'm getting a disability benefit, and my spouse is getting the spousal benefit because she's eligible for that, and isn't working, and then I have children who are getting the child benefit. The total of all of those benefits could add up, especially if you have a lot of kids, right? So if maybe you have a father with 6 children and a spouse, and they're all getting some fraction of the disability benefit, it could add up to be quite a significant sum. And so there's a family maximum that gets applied. So there's a couple, right? The standards here are in bullet 2. So the family maximum is, right, either 150% of the disability benefit, 85% of the AIME, or but not less than the benefit paid to the worker. So whatever you qualify for as a worker, that's the floor. The maximum won't be less than that, but it might be the lesser of 150% of the disability or 85% of the AIME. And where this would be all right, imagine you have a big family with lots of kids. Well, if you hit the family maximum, then whose benefits gets reduced? Well, what it is then the working, so the worker who was currently insured or fully insured, their benefits won't go down, but the other, the spousal and the child benefits will be reduced so that the family total is under the family maximum benefit. There's a lot of so there's other information about surviving parents. I will post these to the page, and there's more information in our reading for this week. And that kind of rounds out the retirement and disability part. So next we have the healthcare part, right? So the HI, medical hospital insurance, is a separate tax, but happens at the same time as Social Security tax, right? There's a Part A tax that's compulsory, 2.9% on earnings, and that goes all the way up. And then there's a Part B where you get supplemental insurance that is voluntary, and so whether or not you participate in Part B or not is your choice, but Part A is compulsory. You have to do it. If you're 65, you're eligible, and eligible for Social Security benefits. You're entitled to coverage under Part A, so you apply. So even if you are delaying taking your retirement payments until 67, 68, 69, 70, if you're 65, you are eligible to sign up for Medicare. So you have to go in and sign up for it, and it functions as medical insurance for seniors, right? And we're all probably very familiar that this exists. So you can individuals are automatically enrolled in Part B as soon as you're eligible for Part A, but you can waive it if you want to, but they generally tend to go together. So, right, okay, so we have all these different possible scenarios and how much each of the payments are, so there's a lot of detail depending on the situation, but generally if you have so generally the worker themselves, if living, gets their full insured amount, and then their spouses and children get a reduced amount, but that amount is increased if the insured worker dies, right? Because then they're not receiving their benefit, but the benefits increase to the rest of the family. So that's why we're seeing these hundreds and 75s on the right and the 50s on the left, is because on the far right we don't have a worker collecting, and on the far left we do, and so so it affects the family different, right? The family effect is a combination of the two things. So there's some reductions that phase in. Oh, so this is important. So tax treatment. So if there are, Social Security benefits are taxed-ish, but not always, right? So for below 34,000, so if you have an income below 34,000 married filing jointly, or 25,000 as a single filer, your Social Security benefits are not taxable. So low income, they're not taxable. Middle income, 50% of the benefits are taxable. So you would your taxable income would be whatever income you got from actually working, plus 50% of your Social Security benefits. And then if you are above this threshold, then 85% of your benefits become taxable. So there is a pretty steep phase in for taxing of benefits. And again, don't forget, because you're working, you're also, so this is your Social Security benefits will pile onto the wages you're already making, pushing you into a higher bracket, and then both getting taxed. So working and collecting Social Security can end up producing high tax bills, especially if your wages are high. There's some withholding amounts for if you retire early, and there's different amounts depending on the what age, right? So this is before full retirement age, and this is at full retirement age. And that's it. So obviously, maybe the big picture, right, is that the benefit calculations are complicated, right? There's a lot of different phases, and it depends whether you enter the system via disability or retirement, and the age at which you do it, and the status of your spouse, married or divorced, and your children, how many, and their ages, right? All these things all factor in to what the benefit will be. But regardless, it ends up being significant payments, right? A lot of money was paid in over your working life, so those payments coming out tend to be, right? I mean, at least the retirement part of Social Security targets something like 45% of your working wages. Right, it's not 100%, but 45% of your annual wages. When you think about how much you'd have to save to get 45% of your working wages, it's a big savings number, right? If you plug that in the financial calculator, you'd get to a big number. So that's Social Security. When we come back, we will talk about the employee contribution plans.